All right, this is it. The final one of the days. You guys are batting cleanup, and to do that, we have Buck Jordan with you guys are Vebu Labs now. Not you were formerly Waymaker, now Vebu Labs.
That's right. Vebu is short for venture.
Okay, and Arthur Chow, you were with S2G Ventures, correct?
Yeah. Yes. Great to meet everyone.
Um, yeah, great to have you guys. This is the investor panel, venture capital and food robotics. We're going to talk about like what's going on there, what's kind of the landscape look like. But before we jump into all that, maybe each of you could spend like 30 seconds to a minute describing your company. So Buck, describe what Vebu Labs does.
Sure. So Vebu Labs is a corporate venture studio. We partner with major brands in this space to build automation solutions and then launch robotic companies in the food space. So our mission is really to automate the supply chain of food from seed to fork, which practically speaking means we're looking to automate the highest consumption food categories in the United States. And we all know what they are. It's pizzas, burgers, especially drinks, coffee. So it's really a crazy robot shop that we're running here. And we partner with these brands who are under extreme pressure to innovate.
And many of the food robots that people are familiar with, if you're following the space, you may know about. Vebu Labs is connected to. You guys are connected to Miso. You
Yep.
guys are connected
I
to, I
founded
think,
Miso.
you found a Miso.
Yep.
And there's a number of other ones out there that are doing different things that you guys are connected to as
And
well.
for whatever it's worth, so when I was running Miso full time, one of the, and this speaks to the broader market, which is what we're here to talk about. When I was running Miso full time, we were really inundated with all sorts of requests from brands that you would normally want to die for to get in front of, just cold emailing our website asking us for really innovative, interesting automation solutions. And so Vibu was really started to kind of tackle that sort of what I viewed as unmet demand in the market.
That's awesome. Now, Arthur Chow, you are with S2G, which is not a automation and robotics specialty venture capitalist focused firm like Box, but you guys are more of a bigger one. Talk a little bit about S2G.
Yeah, we're focused in a different way in the food system overall, and so we invest across the food value chain, really from ag inputs into the ground, and what's kind of automation happening at the farm, to supply chain technologies in the middle, and automation and micro fulfillment there, and then to the consumer end as well, with robotics in the kitchen and also in retail. And so a little bit broad in that sense, but still sort of anything touching the food system, and the ability to kind of invest across, S2G stands for seed to growth, and really multi-stage, meaning we can kind of invest early stage companies to later and growth stage companies.
Yeah, I mean, to me, S2G's mission has always been clear, like, sustainability themes and kind of investing in parts of the food system to help like make the world a little bit better place. And you automation and robotics you see as part of that broader theme.
We do. We really do. There's, I think it's for us, it's human health and planet health. And in that sense, there's issues across the value chain with food security. And, number one is labor. And as we look at sort of the themes that investing behind robots and where we're helping to, replace, but just augment and make labor more productive. And really, there's a lot of kind of pinch points that we're, that's still part of building a healthier and more vibrant, food ecosystem.
All right, well, let's talk a little bit about the landscape where we're at. If people have questions for investors in the space, feel free to drop them into the chat. But I mean, let's be honest, it's tough out there. I've been looking at the CB Insights numbers in terms of overall venture capital. Arthur dropped out. Hopefully, he'll be back in a second here. But overall, like it's just been really tough in terms of if you're a venture investor, right? So, Buck, can you tell us kind of on the front lines as an investor, like how are things going for you? What does it look like out there?
It's tough for robotic companies. It's almost like a tale of two cities. From a commercial standpoint, if you're in the food robotic space, you've got customers lining up out the door because this is a labor crisis. It's structural. It's not going away. It's not a fad, and these brands are screaming for help, and they're willing to pay for it. So the commercial side of all the commercial prospects of all these food robotics companies is stronger than it's ever been, and only going to get stronger. The challenge is that robotics is a really expensive sport. It takes years, 2, 3 years to get to like a commercializable major product. You want to make minor products that you can get that in 6, 9 months, 12 months. But it takes years to get to the first dollar of revenue. and then you've got to start scaling through a pretty conservative industry. You know, the restaurant space, they're not used to having robots in the kitchen. These guys aren't going to buy robots like they buy blenders. Give me 1,000 of them. It's gonna be like, give me one, give me 10. Let me just see how this goes. You know, so adoption's slow. It takes a long time to get to revenue. And in this kind of environment where, first of all, valuations are down by like 50%, you know, VCs in general don't have the patience for this sort of long, capital intensive, high burn strategy that is just robotics. You know, it's like they fund the seed, they fund the Series A, still no revenue. Then they got to do a Series B or some sort of A extension, and then you're still not at revenue. And so there's a huge outcome here for companies who can cross that funding chasm. But right now, there's blood in the water. You know, like Google. Well, anyway, Google any number of robotics companies, and you'll see a lot of them doing serious layoffs. A lot of them doing just having serious problems with financing. Their commercial prospects are
Yeah.
amazing, but the financing is not going to catch up. And so I think what you're going to see this year, especially in the next 6 to 12 months, is you're going to see a lot of die out of a lot of these big brands that I know and you know and respect, or sorry, big robotics companies. And
Mhm.
I think that there's an opportunity here. Sorry, I just ramble on my mic. That there's a little bit of an opportunity here. There's an opportunity for roll up. I think that some companies will get funded, and if they're smart enough to get overfunded, they'll be able to kind of really pick up some incredible assets over the next 6 to 9 months, really. And then, you know, so at a point where the commercial prospects have never been better, you've also got an opportunity where if you've got capital, your competitors are dying on the vine, and many of them are going to call you to be acquired. And so it's just a really weird market environment. I'm
Yeah.
super excited and fearful.
Yeah. I like that Tale of Two Cities. Like Arthur, what Buck just described this like the long time horizon, the challenge. We saw last week or 2 weeks ago, early in January, Picnic had to do some layoffs. They've been one of the most successful on the outward side restaurant robot companies. So, Arthur, what are you seeing out there?
Yeah, I'd echo Buck and a lot of comments around it. It's certainly, you know, with valuation, the hammer has come down hard on the anvil there in the last just really couple of months, even compared to 2022, where there are a couple of shining stars, you know, in the warehouse space that you still had high valuations, but you know they had recurring revenue, and investors now are really looking. It is that kind of as Buck said, these are really capital intensive businesses. So you're just looking at a math equation around valuation, how many rounds you have to raise in the future, and how much you're going to get diluted, and then ultimately an exit value, which there haven't been a lot of exits. And especially now in this market, it kind of starts there where if there's good exits, people will want to invest more in the space. And yeah, some early examples with Kiva, you know, we invest in the ag tech side too with Blue River and John Deere. And Bear Flag, but those are sort of even pre-revenue type examples where now it's harder to make that business case, and so you need to still take that leap of faith. And I think it's the early stage, you know, or later stage investors. A lot of those folks have, you know, they were coming from crossover funds and more in the kind of hedge fund public space like Tiger and SoftBank, and now are that market has cleared up, and that's pushing down on the earlier stage side too. Where I think last year was a little bit more still in it or kind of insulated. Through the back half of, you know, I think I saw a question on pre-seed and seed in the chat, and that was inted. Now I'm seeing that as well kind of get hit hard on the valuation side, and people questioning, you know, can you be more capital efficient and show some earlier proof points? You have to sort of stay focused, as Buck said, and, you know, kind of just it's a fewer use cases. You can't build this big system and platform that is going to be very CapEx intensive and needs a lot of people and engineering to be able to build those, and focus on getting to revenue quicker. Easier
Just to
said than
build off,
Buck, go ahead.
just to build off of something that Arthur said, you know, getting to revenue quicker and these big systems. You know, we all start these food robotics companies with like, let's automate everything, the biggest thing, like let's, you know, and we devise, I'm speaking from experience, guys, and we devise these like huge, aggressive, big projects, you know, they're incredibly valuable, right? But like the capital curve to get there is just so steep. And so I suspect, and I'm certainly starting to do this a little bit more too. I suspect that some robotics companies who are a little more responsible or a little more kind of revenue oriented are going to start paring down their objectives a little bit. They're going to start coming down out with not the full system, but like just this part, just let's say dispensing of pizza toppings. I'm making this up, and selling smaller products out in the market and ultimately building to their big products. But they're realizing they need to start show revenue and start to show progress and milestones.
That's so interesting. Like you look at like 5 years ago, right? Like creators like full stack from like raw onions and meat to like the completed hamburger in a restaurant. Like, and then like, even, but like, Picnic had some struggles, but like their modularity, I think, was what led to some of their success, right? Like, so they were adopted. They had the components of it, Buck, that you're talking about. Like it did a part of it. It didn't do the whole thing. It did a part of it.
I'm actually a huge fan of Creator, and also if I were to give design awards, I would give awards to Molly and Creator for most beautiful robot.
Yeah, they're like both like incredibly sexy robots. If robots could be sexy, right?
Yeah, well, I mean, those two are as close as it gets, but I would say that yeah, I mean, Creator, really has a lot of great technology inside the company, and they could totally part of segments of their business, of their machine, and sell that into the market if they wanted to.
So the roll-up concept, right? Like, first of all, like let's just say it's not just robotics. Like I think there's going to be a shakeout in alternative proteins. I mean, that's a hugely capital-intensive business when you get to something like cellular agriculture and growing meat in a lab. Like there's a lot of markets. There's a lot of companies out there, competitors. So it's not just you guys or robotics. But is there a roll-up opportunity for investors, right? Like, could there be like a startup that just starts to say, hey, you have a great engineering team here. You have this great like onion dispensing component. Is there going to be a roll-up opportunity for someone, a well-capitalized startup?
I think there is, but with a bunch of caveats. So the cost of this roll-up is not going to be buying these companies, because these companies sell for cheap. They sell for cheap because by and large, like the customers of these companies aren't able to take them over. And a lot of times when a company falls in hard times, the customers are the ones who buy them. But if you're a robotics company trying to sell, with a customer of a restaurant, they're not going to take on that robotics challenge. And so the buyers of these companies have to also have robotics teams in-house to be able to appreciate the technology and advance it. And there's a lot of problems when you buy a company and then have to restart it and do all that stuff. And so there's just not many robotics teams out there. And so so that means that there's an opportunity, because you can buy this IP for pretty affordable prices. You can, but you need to have a team and expertise in-house to do that. And so, woe be to the pure financial investor who just tries to start rolling these things up without having a team on board to do that.
Yeah, so this isn't like Google, when Google started buying like Motorola, because there's obviously revenue to be made via selling lots of Android licenses and going out to like phone subscribers. This is a market where like it's not that simple, right? Like it's a much more complicated play. There are some questions coming in. I do want to start getting to those, because like people don't often have a chance to ask venture capitalists about food robotics. One question from Anonymous is debt financing a path to go when a robotic company just starting to have recurring revenue or pre-orders? What about alternatives formats of investing like debt, Arthur?
Yeah, some of our companies have taken on venture debt and other sort of kind of factoring or looking at revenue financing. I think the more, and we have, even within our own S2G, we sort of have a kind of special opportunities debt type of group. And what they look for is that recurring revenue and something of at least sort of a year plus 2 year type of contracts, where you have something that's more set in stone. That's something you can lend against. But it's still, I think, early. If it's one or two customers that you have, or a couple, it's like, if you can, it's the cheaper source of capital. So it's like, good luck to try to get that, and hopefully, if that source is open and available, it's worth tapping. You have to look at down the road if there's certain covenants or kind of terms that might hamstring you in the long run that you want to be careful of. But I think it's in any sense right now, the equity side, the cost of capital has gone so far up, has pulled up the debt side too, but it's still, debt is always going to be a little bit cheaper cost of capital and equity.
Just on that line of thinking, last week or the week before, KiwiBot actually struck a deal with a company out of Europe where they're doing essentially a sale and lease back. So KiwiBot makes the robot, sells it to this company. and the company leases it back to them. So KiwiBot obviously has to face customers or find customers. Delivery robots are a little bit different than I think the ones in restaurants, because you can have a whole fleet of delivery robots for like one company. But anyway, the sale and leaseback model, is that like something like, Buck, you think is reasonable for robotics companies?
Yeah, I mean, so first of all, I think on debt, debt must exist for these companies to scale in the way that they need to
Mhm.
scale, because it's just too expensive to buy like 1,000 robots that each cost like 80, $100,000, $200,000. Like, it can't be done with equity financing. And so there are a lot of debt providers out there that will do equipment financing, especially when because most of these robot companies are using a robots as a service model. So lenders love that kind of SaaS model, and they're willing to finance the hard equipment, which is really critical, I think, to a lot of these companies scaling. And I think that there's a really nice opportunity for a lender who wants to dive into this space and really own that robotic equipment financing space, because it's my view that automation must come into the restaurant industry. There is no other solution. It's not going to be cool again
Hmm.
to work in the back of McDonald's. And so we're going to be if we're going to be living in a world of robots, there needs to be some specialized financiers who specialize in robotic machine financing.
Katanja says, according to you, how many meals per day must a restaurant sell in order to be able to invest in a robot? And what price would they be willing to pay? I guess the question really is like, kind of related to what you said, Buck. It's expensive. These robots are expensive. You have to figure out how much you're going to sell. But part of the equation also, isn't it like, okay, you're going to have to replace a couple hourly workers that are making $40,000-$50,000 a year to pay for $100,000 robot. Is there kind of like you're factoring all these different balances?
So I think that it's fine to just come at this from a cost perspective and just say, like, how many workers, how much cost are you replacing, and make the equation work like that. You can generally make these robotic companies work with a SaaS model, and then have that SaaS be less than the cost of labor. But that's not really kind of taking into account the whole value that the system is providing. So in the quick service restaurant space, it's all about quality, consistency, and speed of service. Those are the watchwords of any good, well functioning quick serve restaurant. Well, quality and consistency you kind of get as table stakes with robotics, so that's a win. But speed of service directly affects top line revenue. If you decrease speed of service, you directly impact the top line revenue of that store. So it's also a revenue gain as well as a cost savings. And personally, where I get really excited, this is of course harder to measure. Where I get really excited is when robots can do something that other than just eliminate or reduce labor and real estate costs, which is generally what robots do. But when they do something that a human or a brand just can't do, something special that really surprises and delights the customer. Like an example that a good friend of mine gave me, which I'm stealing, is we've all ordered half pepperoni, half sausage on a pizza, but we've never had the gall to call up one of these pizza places and order 8 slices of 8 different pizzas, right? But like with robotics, like you could one day
Speak
do
for
something like
speak for
that.
yourself, Buck. Speak for yourself.
Yeah. Well, they probably reach to the phone and try to strangle you. So there's real opportunities to increase quality along the way and make things fresher and more customized for the masses, which I think is really exciting.
Yeah, that's great. I remember one of the things about Creator early on was they were able to make the meat patties in a certain way that humans couldn't.
So cool.
They're
Yeah.
like, that was like one of the things that they were talking about early on, which I actually thought was really interesting. Speaking to your point of like actually not just reducing costs, but adding revenue, for those of you who heard Andrew earlier in the day talk about the fact that his deployment of the picnic robot and these Turbo Chef ovens was the lever he pulled to enable him to do a pizza subscription business, which he's talked about some of the top line revenue growth he's seeing. He's had his 2 best months in a row, January and February this year, ever for a restaurant, which is related to the subscription program, which is directly enabled by the robotics. So, Arthur, like, enabling new revenue use cases and new revenue levers, I think, is part of the robotics conversation, right?
Oh yeah, it has to be in terms of how the unit economics have to work, and that's really kind of where it starts in that fundamental of whether it's a unit at a restaurant, you look across the fleet, or you look at a geo area, whatever it may be, and how you define that. The first it's sort of that gradual build. I think is like I were talking about of you start with one use case in revenue and make some money there, but then you do need to over time build and continue to think about the utilization of the robot and the ROI. And I think as an early stage in a lot across the value chain that there are, selling as RAS and selling as a service can work on a short pilot scale. I think in the long run, if this is truly sort of a machine or equipment in that sense, there has to be almost an ROI, either through that lease payback model as you talked about, or just an outright machine sale and an ROI CapEx sort of payback to that as well. And so that's how you think about scaling in the long run to be able to do that. But it starts with being able to have enabling more revenues, more use cases, and more utilization overall that the customer is going to be happy with.
Buck, Bob says, I think what you're saying, restaurants are slow to adopt. They're not like used to having robots in the restaurant. What locations, or maybe what type of chains or what type of restaurants are we seeing robotics deployed successfully in the back of house?
Well, I mean, Miso Robotics is being very successful in the back of quick serve restaurants. And I think that, there's certainly different segments of the restaurant industry. And I think quick serve restaurants is the natural place where you should first expect there to be, good penetration of robotics, because what is a quick serve restaurant? It's really a distributed manufacturing center. It's the world's largest distributed manufacturing center. This is not about the art of cooking. This is about quality, consistency, speed of service, and preparing simple recipes over and over again. So kind of like a factory, right? With minimal kind of modifications and customization. And so Miso's having some serious penetration in the quick serve restaurant space, which I'm excited about. And I think there will be other companies that will be having similar success, but it's going to start in the quick serve restaurant space, I believe. One of the challenges that quick serve restaurant space is pretty. There's some massive players. Those massive players are going to move slowly, but the mid market players are going to move much faster. It's kind of how you'd imagine things to go. But it is a constant struggle to get rapid adoption, because also a lot of this technology is nascent and still needs proving out. And robots are a little scary and intimidating for the manager of a restaurant whose biggest technology hurdle has been like a POS machine, probably.
Yeah, man, we could go on and talk about this for like an hour, like the challenges around deploying robots. Arthur, as like an investor, if you're looking at this space, this is something you're looking at S2G, like what area do you want, what pitch deck do you want to see on your desk? Like, is there an area in food robotics that you think is a white space that someone hasn't really tackled that you think is an opportunity?
I do think there's a number of interesting food waste companies as well out there that are tackling using automation, tackling that, and it's for us, it's if I think about one area in general where there is more funding out there, or at least kind of a theme overall, and you hear some news about ESG and a lot of pushback, but I think there are a number of sustainability funds out there, and if you can sort of make that case where you're driving that more efficiency in labor and cost deflation, and as Buck said, especially if you're going to quick service, it's such a thin margin that you have to think about cost deflation and how you're helping that, as opposed to just sort of consistency is what I think is important, but it has to be that speed and throughput too. And so that element of where there's that first ROI use case, and I think that, and there's beyond that of some of the food, again, interesting kind of food waste stories you can have an impact there as well. There's capital available, and it feels like it's a different story that's still interest out there in that space.
So we have some questions coming in. We don't have a panel after this, so I'll probably go just a little bit longer if you guys are okay with that. If you have to jump off for a meeting, let me know, because I do want an opportunity to get to some of these. Scott Hymaninger has a really great question for those inventors out there, aspiring robotics entrepreneurs. How far along should food robotics concept? How far along should food robotics, a proof of concept, be before it's ready to pitch to venture capitalists? Buck?
I mean, if you're running a food robotics company, you should always be raising, because you are basically burning cash constantly. So like how far along? At the concept stage, raise money. Once you hit your first prototype, raise money. Never stop raising money, because you are going to run out if you're not careful. I don't know. That's just me.
Arthur, for you guys, what stage do you want to see someone pitch to you?
Yeah, we'd like to see, at least hopefully, there's some type of pilot going on, and getting closer to commercial proof points. It doesn't have to be a signed contract, but if there's getting close to an LOI, some type of, hopefully, kind of beyond a JDA of some sort. But overall, yeah, we're more like, especially now, I think it's the more kind of cash efficient you can be in showing up front to milestones, and having a smaller team to still get to a proof point, at least, of there's commercial viability.
Yeah, and it should be clear, like, for those who aren't familiar with the world of venture capital, there's different stages of venture capitalists, right? And there's seed stage, and there's even before that, like, angel investors. And so, but Buck, you're pretty early in that stage, and Arthur, you're a little bit later in kind of the life cycle, right?
That's fair, yeah, for sure. Kind of, I think for us, more sort of Series A and B and beyond. I think at this point, like, we've done some early seed stage investments. I think someone mentioned Spice there, kind of way back when we were kind of founded in 2014. But I think we're starting to move a little bit later stage now, knowing some of the development risks that you do have there, and trying to fund less of that versus commercialization risk.
Bob wants to know who has a commercial proof of concept using robotics. I don't know if that's a question you can answer, Bob. Is that too general question?
Miso Robotics, for sure. They're providing huge amounts of value to their customers. Serious cost savings, serious increases in speed of service, better quality, better consistency. Team members love it. What I like about Miso is that we're taking one of the hardest tasks in the kitchen, which is standing over a boiling vat of oil for 8 hours or a shift. Nobody really, it's a difficult job. It's tough to do. And if somebody is just on the fryer, they're quitting real quick. Like the average industry average is like something like 175% turnover in a restaurant, which is kind of crazy. But if you're just on the fryer, it's way shorter. To take another task in the kitchen that's really hard to staff. If you're this is amazing stat. If you are a dishwasher, you just wash dishes, you're going to last 42 days. That's crazy. So if you're a manager of a store, you've got to you basically never stop hiring. And so when you take Miso,
or you're washing the dishes, you're washing the dishes yourself.
Yeah, or you're like in a pizza store, for instance, the highest paid person, which is the manager, is mostly cutting pizza and boxing. That's typically where he ends up filling in, because they're always short a crew member.
That's interesting. Is a question from Sarush, where he basically says investors seem to grasp the pain points addressed by robotics and alignment of solutions with the problems, but he says that demonstrating the unit economics and financial sustainability of robotics companies is proving to be a challenge, as we discussed. Do either of you have tips or can suggest ways to effectively communicate the advantages of slower yet more stable growth trajectories to investors? I mean, this is something you think a lot about, Buck, I imagine.
Yeah, I mean, it's really tough, right? Because everyone starts a food robotics company because they have this big idea, like I see Sweet Green in here, and mentioning Spice. Spice had this huge, big, massive vision, which I'm actually totally into. I love that product. But like they, and it's hard for an entrepreneur to say, all right, let's not do this right now. Let's focus on like just having a really nice walk system. I'm making this up, and selling that into the market. And or like, Creator's got this really great like seasoning module, they could sell that into the market, but it's just a really hard, mind flip or whatever, for entrepreneurs to say, we're not going to do the big tamale right now. We're going to do smaller pieces.
That's like, I think, sorry, Arthur, but like engineers and inventors oftentimes have these big visions they want to get to, but like having those like advisors come in at the stage, whether you're in an accelerator or like in an incubator, like to tell you, no, you should do this like spice rack first or whatever. Like, Arthur, is that important to have that right advisor at the beginning?
I think absolutely, in terms of the board and investors you want to have on. And I think the positive to that question was that investors' mindset has certainly shifted, I think, quite a bit around, wanting high growth over profitability, and now looking towards a slower growth but slower burn to get. Still looking for those milestones you want to achieve at the end, but I think it's there's more acceptance towards, as long as the cash burn side of it is a little bit more reasonable, open and willingness to do that. But I think I agree with Becker, as investors in spice and having lived that story, going after being a full, kind of concept restaurant and, our menu creation, it's tough while you're also trying to build a robotics platform, and where they ultimately went to in that B2B sense, there's exit paths beyond having to own your own concept, own your own brand. It's a big undertaking to be a brand and also to be a robotics company. You just need a lot of specialization there, big teams.
I gotta address that. So Arthur's right on. So there's two things I want to say. One is that to attract the kind of capital that Spice attracted, and they attracted quite a bit, you got to have this big vision, which is that big machine, I would wager that most of the investors in Spice, they invested because this huge vision, but they didn't invest, but they would be less inspired by, like, we're going to make a little automated walk, we're going to sell 1,000 of those, we're going to make a little something else and sell that. That might be the practical way to go, but it's not a great way to attract capital. So that's just sort of a structural problem when it comes to raising capital from VCs. But one thing that Arthur mentioned, which is this tendency that's very much a kind of Northern California tendency to, like, own everything. We're going to be the brand. We're also going to be, like, the highly tech enabled, product. We're going to be everything. And I think that's a big mistake. You might think you can do what McDonald's does, or you can, or any one of these big brands, but it's harder than it looks. You might think it's just a branding thing, or it's really gnarly operations and marketing and business. And I would just say my advice to burgeoning robotics companies is, it's fine to have your own brand, but I would really encourage you to also engage with existing players in the industry and help them scale. Because it's harder than it looks, and better to work with the McDonald's with 18,000 stores in California, in the United States, than try to build that yourself, which you'll never do.
Yeah, it's like Silicon Valley mindsets. You're either like owning it all, like maybe that's like the Apple model. You're going to be everything, or you're going to be the platform. You're going to be Intel or AWS, right? Like, it's like oftentimes people think so much in those, but like what I'm hearing in robotics, like, you maybe need to break out of those molds to think a little bit differently.
Yeah. Puck's not wrong in terms of the mentality as, like, an early stage VC. It's, I have to 10x this investment. So how do you get to that, $1 billion IPO type of exit? Because half the portfolio is going to go under. So that's the balance you kind of have to play. But that is, and that's why VC dollars aren't always the best in terms of robotics, or at least not some of the early stage.
I would just pile onto that. We're dealing. The bright side of this industry is that the customers out there are just screaming. Like, they call this a labor crisis, not a problem. And everyone knows it's here. And some of these brands are willing to pay meaningful non-recurring engineering to help you build a solution for them, and they're willing to do that because it works for them and it works for you too. So I would encourage trying to get an alternate form of financing through non-recurring engineering.
It's interesting. Scott brings up an interesting question, like, how many robotics companies have reached $1 billion valuation? And I don't. There probably is some. Like, food robotics is more nascent. It's more nascent, right? Like, you can't really point to one. But we saw once, like, the smart home saw, like Nest, like there was a Nest, right? And then there's like a Ring. At some point, are we gonna have like a Nest or a Ring in like food robotics?
Oh yeah, watch me sell robotics.
Well, we could go on forever. We've already taken more time than you guys. I promised, or I asked of you guys. I don't want to take any more time. But real quickly, I do want people to be able to find you. Buck, how can people find out more about what you're doing?
Buck at vebulabs.com.
Awesome. And vebulabs.com there's a website there they can also find, I imagine.
Yeah.
Okay. And Arthur, how can people find out more about what you're doing? I think you're muted, Arthur.
Sorry. Yeah. So two options there. If you're interested in more of a pitching and pitch deck, we have investments at s2gventures.com. And so that will get funneled through our pipeline. And then personally, it's just Arthur at s2gventures.com.
Great. And this has been a really active conversation in the chat here. So if you guys want to stick around and maybe answer some other questions I didn't get to. There's people with also like some really thoughtful comments that I couldn't get to. So thank you everyone for that. As always, it's a lot of fun working with this community. And Buck and Arthur, thank you for doing this. This has been awesome.